A DVR stands for differential voting rights. That basically is what the full form of DVR is. Now, by the name, obviously that's the implication that the DVR has, right? That in case you are a owner of a DVR, you will have differential voting rights. Now, typically, what that means is, for any shareholder, right? Whenever you buy shares in a company, you get equivalent voting rights against that company. And what does that mean? That basically means that let's say if you have 10 shares, right, and let's say there are 100 shares that are issued. So typically you have 10% of voting rights of the company. Now, typically what happens is, as retail individual investors, what we do is, we really don't take a lot of active participation in the voting decisions of the company. So, which is why, that is typically a right that we would not care about much. So this was actually introduced for the first time by two companies together, which was Future Retail and Tata Motors. Tata Motors, when they had done the JLR acquisition, at that time the Tata Motors stock was trading at around 68 rupees, and they issued the DVR at 60 rupees, right? And the logic for that was fairly simple. They said that you're doing this, we are doing this acquisition, we'll generate a lot of free cash flows. So what we'll do is we'll raise additional capital without diluting our voting rights. And for shareholders of DVR who are extinguishing their voting rights, we'll compensate by paying a higher dividend, right? So if I look at the terms of what Tata Motors DVR is, right, and this is again from their annual report. So let me just go right there and then we'll come back. So this is what it says, right? So they call it the A ordinary shares. So the holders of A ordinary shares are entitled to receive a dividend for any financial year at 5 percentage points more than the aggregate rate of dividend declared on ordinary shares for the financial year, but are entitled to one vote for every 10 A ordinary shares held as per the terms of its issue and the articles of association. So what that typically means is, if you hold 10 shares of DVR, you get one voting right? And at the same time, whatever dividend is declared for ordinary shares. So let's say tomorrow Tata Motors declares a dividend of 10 rupees for ordinary shares. As a shareholder in DVR, you get 10.5 rupees. So you will get 5% more dividend because you've extinguished your voting rights. So these are the terms for Tata Motors DVR, right? So that begs the question, why do company issue DVR? So think of it this way, right? And this was again in recent times a classic case that happened with Uday Kotak's bank as well, right? So in Kotak Bank, there was the foreign institute, the promoter holding had to be brought down, and this was again fought by Harish Salve, the lawyer, and they had got this ruling from RBI that, look, I don't want to sell my shares, so you cap my voting rights at 26%. So even though I hold more than 26% shares in the company, let's not make me dilute the holdings in my company, but you can cap my voting rights at 26%. So from time to time this has happened. DVR, it's fairly simple, it's clear cut. So as investors, again, we don't, because we don't participate a lot in the decision making of the business. We don't participate a lot in the decision making of the business, so we can extinguish those rights to get a higher share of dividend, right? So what happens is, and what happens is, when you issue DVR, there is no significant change in the capital structure. What that means is, let's say if you had a pool of 100 shares, you can still issue 80-90 shares and 10 shares of DVR and still have voting rights which are capped at the total number of shares, right? So please ignore these two lines. These are from my older presentation, they've not been removed. So the point that I'm trying to make is, when you look at DVR, you're basically compensating for your loss of rights by way of receiving extra dividends, right? Now, in the Indian context, before we come to the Indian context, we'll talk about the global context. So in the global context, context, there are multiple examples. So there's Berkshire Hathaway, there's Alphabet. So Alphabet again, is the holdco of Google. Now Alphabet has three class of shares. So you'll see there's Class A shares, there's Class B shares, and there's Class C shares. For Class A shares, for every one share you buy, you get one vote. Class B shares are not traded on the market. Class B shares are for insiders, for employees, so on and so forth. In Class B shares, you get 10 voting rights for every one share that you own. And then there are Class C shares. For Class C shares, there are no voting rights. And typically, you will see that Class C shares will carry a higher dividend yield because it's compensating for no voting rights. So that is a global context. It's not that DVR is unique to India, it's a global concept. It's just that in India, the only company that has still survived the test of time when it comes to issue of DVR has been Tata Motors. So Future Retail again admitted to bankruptcy and admitted to insolvency, and then right now its matter is currently sub judice. Again, the other companies, Jan Irrigation had to liquidate, so the value of DVR is worthless. Similar was with Gujarat NRE Coke, had to be liquidated, so DVR's value is almost next to worthless. So the only example that's actually standing the test of time, for the lack of a better reference, is Tata Motors, right? This basically, we've discussed what the terms of this DVR are. So now think of it this, right? When Tata Motors was actually a part of the Nifty 50, and this is an article from 2016, the Nifty was actually computed based on the stock price of 51 securities, but it will continue to have 50 companies. Now, similarly, when you look at the S&P 500, right, it's based on 505 securities, right, against those 500 companies, because there are DVRs of Alphabet, News Corp, Discovery Communication, Comcast, 20th Century Fox. So a lot of companies do this precisely for three reasons. Number one, can we sweeten the deal for retail investors? Number two, can we raise additional capital without diluting rights in our existing core stock? And thirdly, this also creates a distinction between shares, let's say, which institutional investor would want to own versus, let's say, shares which individual investors or investors with a mandate of making a higher fixed income would want to own, right? So typically you will see mutual funds don't go and typically buy a DVR. They would much rather buy the stock, right, rather than, let's say, buying the DVR. But in recent times, what has happened? So if you remember what I said a while back, when the DVR was issued, the stock of Tata Motors was at 68, right? And the DVR was issued at 60. Typically, the difference between the two should not be more than 5 to 10%, right? Because there is a 5% higher dividend yield. So that is the compensation it should do. At the same time, the discount should not be as high as 50%. So the discount should ideally be between 5 to 10% to 50%. It should be somewhere in the middle. That's what a DVR should ideally be, right? Now in India, if you see right now, the discount is quite high. Maybe over a period of time, we'll see this discount catch up, which is why you will see right now, in recent times, the stock of DVR has actually gotten a lot of active interest from investors alike. Because and again, if this year's performance was anything for us to see, this is a 1 year chart between Tata Motors and Tata Motors DVR. So the yellow chart is actually the DVR and the blue chart is the stock, right? So the yellow stock, which is the DVR, it has actually outperformed the core stock by more than 50%. So while Tata Motors has gone up 49%, DVR has gone up 75% in a 1 year time frame. So there is some catch up that's happening. But despite all of that, right, if you see, the discount is still significantly quite high. The discount is actually more than 50% today. So as I said, ideally, as an investor, this discount, if you're buying DVR, right, obviously you're hoping, you are anticipating future free cash flows from the company, and as a result of which, whenever a dividend is declared, you get a higher share of the dividend. That's number one. Number two is you're also betting on the fact that this discount, which is currently between Tata Motors and Tata Motors DVR, over a period of time, that's gonna play catch up. And you will make sure that let's say someone who invested a year back compared to now, you will ensure that you end up making superior returns if you're bullish on the core stock, right? So